Hello everybody, this is Okpeyemi. Welcome to my free forex trading course. You can remember the last lesson, which was lesson 10. We discussed the following outline. We discussed the doji candlestick pattern, the dragonfly doji pattern, the gravestone doji pattern, the morning star, and the evening star. So in case you missed it, you've not watched this lesson, you can click the link below to get the lesson. Now today we shall be moving into in lesson 11. Shall be moving into lesson 11. This is this. So we have the hammer, which is also called the pin bar. You have the shooting star, which is called the bearish pin bar. You have the Harami pattern, which can also be called inside bar. You have the tweezer tops and bottoms. You have the tweezers, tops, and bottoms. Now the hammer. As the name indicates, we all know what the hammer. We all know what the hammer looks like. Now the hammer candlestick is created when the open high and close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. As the name indicates, hammer. We all know what a hammer looks like. We know how it looks like. It's the same way this candlestick looks like. Now look at this. Can you see that it looks like a hammer? Now, what is the psychology behind this? You can see price opened. Now, price opened here. After opening, what happened? It went down. The bears, they pushed it down. And the sellers, they pushed it. They pushed price down up to this place. But the buyers, they responded and pushed the price back up to the closing price here. So making it to form a hammer, or we can call it pin bar. Look at this long shadow. Now, what happened here? Price opened, went down, but it didn't stay down. The buyers, they pushed it back up, making it to form a long shadow. So what does that mean? That means the buyers, they showed more aggression by pushing the price up. So that can help us to determine what will happen in future. The hammer is a reversal candlestick pattern. When it occurs at the bottom of a downtrend, the hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lowest price. That is when a hammer is formed. And when you see a hammer, it is telling you something, that the buyers they are showing strength. They are showing strength. So if it happens as I told you earlier. I say if it occurs at the bottom of a downtrend, let's say there's a downtrend, price has been going down, and suddenly a hammer was formed. That means there is a possible reversal. Now look at this. Look at this chart here. Price was going down. It was going down. Then suddenly a hammer was formed. Remember, it must happen in a support zone. This was a support zone. Then what happened next? Immediately the hammer was formed, price started going up. So that is a hammer candlestick pattern. Now, as you can see, the market was trending down. The formation of the hammer was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but in the level, the buying. Sellers were trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which results in a trend reversal. The most important to understand is the psychology behind the formation of this pattern. If you can understand how and why it was created, you will be able to predict the market direction with high accuracy. As I've told you before, you don't need to cram the pattern. You don't need to cram it. All you need to know is what happened, what really happened, the circumstances behind the formation. That is all you need. The psychology behind the formation. That is what you need. So you don't need to cram the name. And the next one is the shooting star. Shooting star. You can also call it the bearish pin bar. You can also call it the bearish pin bar. The shooting formation is formed when the open low and close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is the bearish version of the hammer. Professional technicians say that the shadow should be twice the length of the real body. So the shooting star is just like the reverse, just like the opposite of the hammer. Look at it here. Look at the shooting star. You can see the long shadow up. Now, the color does not matter now. The color of the body doesn't matter. But the pattern, the shooting star, that's what matters. You can see. Now, what took place here? What happened here? Price opened here. You can see this arrow. Price opened here. Then went up. When price opened from here, it went up, got here. But it did not stay there. It went back down and closed here. Now, what does that tell us? It shows that the sellers are showing strength. So that, and if it happens at the top of an uptrend, that means there is a possible reversal. If it happens on a resistance level, a major resistance, so that means there is a possible reversal. The illustration shows us a perfect shooting star with a real small body and an upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. The psychology behind the formation of this pattern is that buyers try to push the market higher, but they got rejected by his selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. Look at this chart. You can see price was going up. It was going up. And suddenly, a shooting star was formed in a resistance level, a major resistance. Then what happened after that? Price went down. It went down. So that's the shooting star. The chart above shows a nice shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend move and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand areas, and with technical indicators. The shooting star is very easy to identify and it is very profitable. It is one of the most powerful signals that I use to enter the market. Once I see it, and that maybe the resistance is a major resistance, then I enter the market. The next one is the Harami pattern. The Harami pattern can also be called the inside bar. Now, the Harami pattern in Japanese is called pregnant. That's what it means in Japanese, pregnant. It's considered as a reversal and continuation pattern. And it consists of two candlesticks. The first candle is a large candle. It is called the mother candle, followed by a smaller candle, which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. This candlestick is considered as a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. Look at it. Yes. See, the first one is the mother candle. See, a big candle. Then the second one is a small candle. A small candle. So this is what we call the Harami pattern. This is a bullish one, a bullish inside bar. Why? Why is it a bullish inside bar? You can see this. This is a bullish, and this small one is a bullish candle. And look at this. This is a bearish inside bar. And see the mother bar, the long candlestick. Then the small one. This is what we call Harami pattern. Now, as you see, the smaller body is totally covered by the previous mother candle. Don't bother yourself with the color. The most important is that the smaller body closes inside the first bigger candle. Color does not matter. The Harami candle tells us that the market is an indecision period. In other words, the market is consolidating. So, buyers and sellers don't know what to do. And there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it is occurred at the top of an uptrend or at the bottom of a downtrend, it is considered as a trend reversal signal. So meaning this pattern can be used as a continuation pattern, and it can also be used as a reversal pattern. So, look at this chart. Look at the bullish Harami. Look at it here. There was a downtrend from here. That was going down from here. That was going down. And suddenly, Harami was formed. The bullish Harami was formed. You see, then there was a reversal. Price started going up. You can see here too. A bearish Harami was formed after an uptrend. Then what happened after that? Price fell and went down. Now, in the chart above, you can see how the trend direction changes after the Harami pattern formation. The first bullish Harami pattern occurred at the bottom of a downtrend. Sellers were pushing the market lower. Suddenly, price starts consolidating, and this indicates that the selling power is no longer in control of the market. The bearish Harami is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that buyers' domination is over and the beginning of a downtrend is possible. When this pattern is created during an uptrend or a downtrend, it indicates a continuation signal with the direction of the market. Now, the next one is the tweezers, tops, and bottoms. Tweezers, tops, and bottoms. The tweezers top formation is considered as a bearish reversal pattern seen at the top of an uptrend, and the tweezers bottom formation is interpreted as a bullish reversal pattern seen at the bottom of a downtrend. Look at this. Look at this tweezer bottom. And see, first of all, there was a bearish candle, and immediately after that, there was a bullish candle, cancelling it out. If we do the mathematics of this, this will give us okay, look at this. Okay, I'll go into that later. Now, look at tweezer top. Bullish candle. The first was bullish, a bullish candle. Then the second one was a bearish candle. What does this mean? Price went up, and suddenly went down again and closed at the same level or almost the same level. What does this mean? The tweezer top formation consists of two candlesticks. The first one is a bullish candlestick followed by a bearish candlestick. And the tweezer bottom formation consists of two candlesticks as well. The first candle is bearish followed by a bullish candlestick. So we can say that the tweezer bottom is the bullish version of the tweezer's top. The tweezer's top occurs during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up. But sellers surprise buyers by pushing the market lower and close down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we can combine this signal with other technical tools. The tweezer's bottom happened during a downtrend. When sellers push the market lower, we feel that everything is going all right, but the next session price closes above or roughly at the same price of the first bearish candle, which indicates that buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates that a bearish reversal is likely to happen. Look at this. Look at this chart. See, price was going down. Then suddenly, a bullish candlestick cancelled out the last candlestick here. At the same level. The same level. So, immediately after that, price started going up. It went up. It went up. And you can see what happened here again. This is a bearish Harami. Then it started reversing again. The chart above shows us a tweezer bottom that occurs in a downtrend. The bears push the market downward on the first session. However, the second session opened where prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of a candlestick. No, I told you before. Try to understand the psychology behind its formation. This is the most important. You don't need to cram any candlestick pattern. Just understand what happened there and be able to identify it. That is the key thing. That is all you need. You don't need the name. The name is not important. You are not writing exams. So the name is not important, but your ability to identify it and know the psychology behind it. You know what happened, what took place. So that will help you to take your decision on what is next to happen. Because if you can understand why it was formed, you will understand what happened in the market, and you can easily predict the future movement of price. That is just it. That is what a candlestick pattern is all about. There are still more. Maybe in the next class, I will show you some other ones. I'll show you some other candlestick patterns. But these are the most popular ones. So, and when you open your chart, they are the ones you see most often. So there are some other ones that are rare. Maybe in the next class, I'll show you those ones. So see you in the next class. And remember, if you are new to this lesson, please make sure you subscribe to my channel, like my video, and hit the notification button so that when I post the next video, you will be able to get the notification. Thank you.